Your credit score is an extremely important part of your financial health. Having a good credit score can save you thousands of dollars in almost every aspect of your life. That's because a good credit score can unlock major savings and benefits such as access to all types of loans, the best credit cards, the lowest interest rates and terms, a variety of discounts, and even access to more housing options than other people, all because a good credit score represents that you're financially trustworthy. So on this video, I'll be showing you exactly how to build your credit score so that you can enjoy all the amazing benefits that come attached to having a good credit score. So to begin with, what is a credit score? In the simplest terms possible, a credit score is a 3-digit number designed to represent a person's credit worthiness or the likelihood of a person paying back debt on time. This number is used by banks, lenders, credit card companies, and even landlords to determine how responsible you are with your finances. The higher your credit score is, the more banks and lenders will trust you with money and be willing to lend you money with better, favorable terms. Now, there are 3 major credit bureaus who are responsible for determining your credit score. That's Equifax, Experian, and TransUnion. They collect data about you and how you've used your credit score to then create your credit reports, which is what your credit score is based on. Now, the way your credit score gets calculated is simple. Your credit score is made up of 5 factors: payment history, credit utilization, credit history, credit mix, and new credit. Your payment history counts for 35% of your overall credit score, and it simply shows a record of how you've paid your account over the length of your credit. It's also the most important factor in your credit score, and it has the biggest impact on your score because it shows the likelihood of you paying back on time. So when building credit, you want to essentially build a long history of on-time payments. In other words, never miss any payments on any of your accounts if you can. The main goal here is to have a payment history of 100% because that'll highly boost your score and show banks and lenders that you always pay on time, which can in return benefit you in many ways. The second most important factor is credit utilization, which makes up 30% of your score. This simply represents how much credit you're using compared to your total available credit. For example, let's say you have 4 credit cards with a total credit limit of $10,000, but you decide to spend $3,000. That would put your credit utilization at 30%, which is not good. Ideally, you want your credit utilization to be under 30%, but personally, I would keep it under 10% if possible for better results based on my experience. And the best way to keep your utilization down is by always paying off your credit card balances in full every single month. To be honest, that's actually the best practice when using credit cards in general, because this will not only help keep your utilization down, but it'll also prevent you from dragging credit card balances and having to pay high fees and interest on those balances. Now, if you need to spend more than 10% of your overall credit limit due to an emergency, etc., you can easily do so and still maintain a low credit utilization by simply paying your balances off in full before your bill is due. That way, that high balance in utilization does not get reported to the credit bureaus and it doesn't affect your credit score. Another thing you can do to help keep your utilization low is simply ask for a credit limit increase on any of your credit cards. Doing this will increase your total available credit limit, which will in return lower your credit utilization and allow you to continue spending the same amount of money as you were before. For example, spending $3,000 out of a $10,000 credit limit would put your credit utilization at 30%. But if your overall credit limit increases to $20,000, then your utilization would drop down to 15% because of that increase, which is actually under the 30% recommended utilization percentage that we talked about earlier. Now, there are some things to be aware of when asking for a credit limit increase that may affect your credit score, so please be careful when using this method to lower your credit utilization. And for those who want to learn more about credit limit increases, how they work, and how to get one, I'll be leaving a link to a video I made on the topic down in the description for you guys. Moving forward, the third factor that makes up your credit score is length of credit history, or your credit age. This makes up 15% of your credit score, and it simply represents an average of how long you've had all your credit accounts open for. For example, if you have 3 credit cards and one has been open for 2 years, the other for 3 years, and the last one for 4 years, the credit bureaus will add up the length of all 3 cards, in this case 9 years, and then divide that number by the total number of cards, which would give you an average credit age of 3 years. Now, the higher your credit age is, the better it is for your credit score. So something you can do to improve your credit age is avoid closing credit cards because the longer your accounts stay open, the better it'll be for your score. Even if you no longer use a credit card, don't close it, especially if the card has no annual fee, because it's essentially free to keep it open. Of course, there are some exceptions to this. For example, if you have a credit card that has some sort of spending requirement you must meet in order to maintain the account open, or a card with high annual fees, or a deposit that you'd like to get back, then you may consider closing. But before you do that, here are some tips on how to avoid closing your credit cards. For credit cards with no annual fees, instead of closing the card, you can try asking for a downgrade to a no annual fee credit card. That way you can keep the account open for free. Same goes for security deposits on secured credit cards. You can ask to see if there's a way for them to return your security deposit without closing your account by maybe upgrading your card to an unsecured one. Obviously, in the case that none of this works and you just can't continue paying for an annual fee, or you simply just want your deposit back, then you can consider closing your account. Just know that it will lower your overall credit age. And to give you a visual using our previous example, you have 3 credit cards with an average credit age of 3 years. If you were to close this credit card, for instance, that would erase 4 years from your total credit age, making it drop from 3 years to 2.5. And as a result of that drop in your credit age, your score will also take a hit. So again, just make sure to keep your accounts open, especially if they're free to keep, if you want to improve your credit age over time. Another thing to keep in mind is that opening multiple credit cards will also lower your credit age. This may not make a huge difference if you've used credit for several years, but if you're new to credit, try waiting 3 to 6 months per application. Lastly, remember to put some activity here and there on the cards that you don't use very often, because inactivity after a long period of time may get your credit cards closed. And again, we don't want that. You can simply buy a coffee or a sandwich here and there just to show some activity on the credit card, and you should be good to go. Now, the fourth factor that makes up your credit score is your credit mix. Your credit mix makes up 10% of your overall credit score, and it refers to the types of different credit accounts that you may have on your credit file, such as credit cards, mortgages, loans, etc. Essentially, maintaining a mix of credit demonstrates that you can handle different types of credit accounts, which in return helps boost your credit score, and it shows banks and lenders that you can handle debt. So one thing you can do to increase your credit mix is simply add more credit accounts over time. Now, there are 3 different types of credit accounts that you can apply for: installment credit, revolving credit, and open credit. Installment credit has a fixed end date with a series of payments due every single month. For example, mortgages, student loans, auto loans, and personal loans. Revolving credit does not have a specific end date or a set balance. For example, credit cards, home equity lines of credit, and personal lines of credit. And lastly, open credit requires you to pay your balances off in full every single month. For example, charge cards and utility bills. Now, the fifth and last factor that makes up your credit score is new credit, and it makes up the remaining 10% of your credit score. It simply represents any new credit you've recently applied for, better known as hard inquiries or hard pulls. A hard inquiry is done whenever a bank or a lender checks your credit file to determine how much risk you pose whenever you go to apply for a credit card, loan, etc. And those hard inquiries may negatively affect your credit score by a couple points. Now, hard inquiries stay on your score for 2 years, but the good news is that they only affect your score for 1 year and typically have a small impact on your score in general, especially if you've established some credit, so I wouldn't worry too much about it. But it's definitely a good idea to not apply or open a bunch of new unnecessary accounts, because those inquiries will definitely stack up and hurt your credit score, especially if you're new to credit. Okay, now that we got the fundamentals down, let's talk about how you can build credit as early as yesterday. The first thing you can do if you're new to credit and you're trying to build credit is simply get a secured credit card. A secured credit card is a credit card that requires you to make a refundable security deposit in order to open your account. And that deposit usually equals your credit limit. In other words, the total amount of money that you can spend on the card. This deposit acts as protection for the card issuer in the case that you were to stop making payments on the card, but it's completely refundable whenever you choose to close your account or ask for an upgrade, as long as your account is in good standing. Now, secured credit cards can boost your credit score by a lot if you use them responsibly. By responsibly, I mean making on-time payments and paying your balances in full every single month. After a couple months of using your secured credit card responsibly, you should have some credit built up, or at least enough for you to qualify for an unsecured credit card. During that time, you can ask for your deposit back, or you can ask the card issuer to upgrade your card to an unsecured credit card. That way you can continue building credit while earning great rewards from a higher tier credit card. Second thing you can do to build credit is become an authorized user on somebody else's credit card. As an authorized user, you can use somebody else's credit card in your name, like your parents, spouse, etc., and use the card as if it was yours, except you're not the primary account holder. Now, what's cool about being an authorized user is that you can easily piggyback on somebody else's responsible credit habits, and that can help you build your credit history as well as boost your credit score, because everything that happens on that account will be reported to your credit file as well. That being said, it's extremely important to choose carefully whose account you become an authorized user on, because just how responsible credit habits can help you build credit, irresponsible and poor credit habits can have a negative impact on your credit score as well. So try to only get added as an authorized user on people's accounts who you know care about their credit and are responsible with it. Lastly, the third thing you can do to build credit is have someone co-sign on a credit account, such as a credit card, auto loan, personal loan, etc. Much like becoming an authorized user, getting a co-signer to pledge for you can definitely help you build credit, because it may allow you to access or qualify for credit that you wouldn't have qualified for if you tried on your own. You can build credit easily this way by simply making on-time payments, never carrying balances, paying balances off in full every single month, and implementing all the different responsible credit habits we've gone over in today's video. Believe me that if you strictly follow everything we went over on today's video, you will 100% build credit in no time. Now, there are a couple other ways to build credit that I won't be going over on today's video, because if I do, we'll be here until tomorrow. But if you guys would like to learn other ways to build credit or increase your credit score, comment down below part 2 and I'll work on a second part video for you guys. Having said that, that's gonna be the end of today's video. I hope you guys found value in today's video. If you did, hug the like button, subscribe, turn on those post notifications, that way you don't miss out on any future uploads, and I'll catch you guys on the next